Welcome back, it's Erica, and in this video, we're talking about how principal-only payments work. Whether you have a student loan, car loan, personal loan, this is important to understand because it could save you a lot of money if your lender allows principal-only payments. And be sure to stick around until the end because I'll also go over some things that you want to watch out for that could actually end up costing you a lot of money. But first, don't forget to hit the thumbs up because it really helps the channel out, and thank you so much to SoFi for sponsoring this video. Diving right in, the great thing about principal-only payments is that they could help you to pay off your loans faster. That's amazing, right? Everyone wants that. The way it works is usually when you're making loan payments, your payments are going towards both the principal and the interest. The principal is the amount you took out. Let's say you took out a $10,000 loan. So the principal you need to pay back is $10,000, but you're probably going to end up paying back more than that because the lender is charging interest on top of that. Interest is what you're paying to actually borrow the money. Sometimes when you make extra payments in addition to your minimum required monthly payment, those extra payments go directly to the interest and fees, and that doesn't help you to tackle the principal. But if your lender allows it, then if you designate extra payments to go directly to the principal, you're tackling the principal, and that could actually reduce the amount that you pay in interest. That's my favorite part of making these principal-only payments because any way I can find to reduce the amount that I'm paying in interest, I'm in. Another benefit is that if you put more money towards the principal, then you might be able to pay off the loan faster. If this all sounds great, then what you need to do first is to find out if your lender allows principal-only payments. If you've watched some of my student loan videos, you know that I graduated from law school with over $200,000 of student loans. I refinanced those loans with SoFi, and luckily for me, they did allow principal-only payments. If your lender says they do allow them, then you'll ask them how to make those principal-only payments. For me with SoFi, it was as simple as sending a message to customer service saying that I wanted all of my extra payments to be principal-only payments. But each lender might have different rules, so you want to make sure you figure out your lender's rules and follow them. Then the next step, once you've made that first extra principal-only payment, is to make sure that the payment was applied correctly. You don't want to just assume that your lender applied it correctly, so with every principal-only payment, please double check. Just go to your online portal or the statement and make sure that the numbers show you that your principal-only payment was in fact only applied to the principal and not the interest. Now let's talk about some of the things that you want to watch out for that could end up costing you money. With any loan, you always want to understand exactly the terms you're agreeing to before you sign on that dotted line. One of the things that could exist in the fine print is something called a prepayment penalty. This isn't going to be the case for student loans, but some mortgages, for example, might have them. Prepayment penalties and how much they are and how they work can differ by lender, but typically it's a penalty that you have to pay if you pay off your loan early or if you pay a large portion of your loan at once. If you're not sure if your loan has a prepayment penalty, then you'll just want to call up your lender and confirm, and if there is one, learn how it works. Because if there is a prepayment penalty, then that could defeat the whole purpose of making principal-only payments to try to pay off your loan sooner if you're going to get hit with that penalty. Another warning, and something to think about if you have other high-interest debt like credit card debt, then instead of using that extra cash that you have to make principal-only payments on your low-interest debt, it might make sense for you to use that extra cash to tackle the high-interest debt. Because by doing this, you might save more on interest overall. If you want to learn more about refinancing or consolidating your loans or other debt with SoFi to help you potentially save money, I'm going to leave a link to a calculator below where you can get an idea of how much you could save. And if you're interested in more personal finance content, you can subscribe to the channel. I talk about saving money and making money every week. Next up, I'll see you in this video where I talk about how I paid off over $200,000 of student loans. Have a great day.